All right. Good evening, everybody. Thank you so much for joining this session around self-managed super funds. If you came to learn, this will be a really good investment of your time. I understand how busy we all are, so it will be quick, short, sharp session when we go through self-managed super funds, what the benefits, how they set up, and how you can make it happen for yourself. Some of you might know me. My name is Andre. I am one of the mortgage brokers working at loan market. Some of you might know Cornel Palma, who's a head broker in the business, and she's also here on a call with us. So for agenda today, we will start with Paul, who is a director and financial planner of SB Financial Advisors. Paul will give us a general overview of self-managed super funds, risks and benefits. I will then touch base on the lending side of things, and we will finish with Justin, who is an accountant and the director of accounting, and he will talk to us about how it's all set up. So without any further ado, Paul, the floor is yours.
All right. Good evening, everyone. I'm excited to be here tonight to talk about self-managed super funds. It's a topic that I'm really passionate about, and I think it's a really great way for people to become more engaged with saving for their retirement. So tonight, I'm going to take about 10 minutes to cover just some of the very big ideas around self-managed super fund, how it can provide great opportunities not only for investments but also being able to use it from a more functional or practical point of view to be able to work as a couple or family unit. But as you can imagine, as a financial advisor, before we get into it, I do have to give a quick disclaimer. So, to the extent that any advice contained in this presentation, uh, it has been prepared without taking into account, of course, your investment objectives, financial situation, or needs. So, before acting on anything you hear tonight, it's recommended you consider whether it's appropriate for your circumstances, or better yet, consider reaching out to get some advice. Thank you. All right. So a bit of an overview. Been a financial advisor for almost 10 years. I've got a range of qualifications in finance and also financial planning industry. And particularly self-managed super funds is an area of great interest to me. So why have a self-managed super fund? It's important to, I think, quickly just recognize at first that as Australians, we do have rather unique opportunity that at its core, superannuation, which I know that a lot of people's eyes might glaze over a bit when we talk about, at its core, it's just a set of very generous tax environment that we can operate in that's there for us to use as long as we follow a few simple rules. And for a lot of people, superannuation is quickly linked to industries or their employer or a lot of things that are a little bit more abstract to us, especially in our working lives before retirement. But in Australia, we have the advantage to use these same rules to control our investments or our retirement savings with all of those same concessions intact through a self-managed super fund. Whereas a lot of people usually having more control over your money or where it's invested means losing some of those tax concessions, especially around the world. So, two terms that people often familiarize with self-managed super funds is about control and flexibility. So, as I touched on, I find that these are really closely linked to, firstly, investments. So, having control over what you choose to put your fund into and having the option to choose things not normally available, like residential property, commercial property. This can even be a commercial property for business owners that's used for their business, as well as other things like precious metals, gold, collectibles, and yes, even cryptocurrencies. But where the big power of this often comes from is the ability for more than one individual to manage their retirement savings by themselves, but to be able to combine the resources of a family or even a couple together. And as of a couple of years ago, the limit for super funds actually increased from 4 members up to 6. Obviously, more heads together running a fund can create some other headaches in a way, but being able to combine the resources of up to 6 people at once does create some big opportunities and access to types of investments that is well above what most individuals might be able to consider. And of course, the ability to borrow money is something completely unique to self-managed super funds. First of all, this example is designed to give us a bit of an overview of some of the benefits of having multiple members and the functional or practical side. So let's imagine for one that we just have a couple, they could be in their 40s and they decide to set up their own super fund today. And they have a bit of a preference for property. So they decide to use their combined balance now, which might be around 300,000 to pull that together and they invest in maybe a diversified fund as well as an investment property. Eventually they might have some adult children in the picture. So what we have here is a couple that have continued to build their savings through to retirement. And now they've got quite a nice balance here, all going well, maybe over 20 years or more. And we now have an opportunity where this fund might consider adding some new members. And not just to increase the size of the pool of resources here, but because we might be happy with trying to maintain these assets here, mum and dad are looking to start drawing some income to live on. And the son and daughter have the choice of maybe sticking with the default fund their employer might offer, or being able to learn some important lessons and familiarize themselves with wealth creation through the fund. So they could have their contributions now contributing to the fund, providing some useful cash flow. But what's going to happen over time here is that this pool of assets, even though all four people are in this together, they each still hold their own unique share, at least on paper. So mum and dad obviously have a much bigger share to start with, but over time, the children's share will begin to increase as they put more money in and mum and dad start to draw down. But over time, this could help that their share of the assets just becomes more on their side. And the pool of assets here can continue to grow and doesn't actually need to ever be sold down potentially. All right, let's move on to another example. So here we've got something that might be a little bit more familiar to some people, and that's the unique side of being able to have control over your investments. So let's imagine this is a bit more like the couple above, and they're looking at setting up their self-managed super fund, or at least interested in the strategy, and they might have a preference to have an investment property included in this. So we've got nearly 300,000 to start with, which is a good tally for someone at this stage of life. Let's just move on to the next slide to show what might happen here. This is a really quick summary of the projection. And obviously, for those interested, I can go into a lot more detail of the numbers. But let's imagine this couple decide to just continue in their balanced fund. They continue in their balanced fund, which is often your default choice for a lot of super. And based on that trajectory, they might end up with something like 700,000 in 10 years, which is not a bad result. But it's not exactly the way they want to go. And they've got a good mind for looking at investing in property. So they want to go down this path. So we've got some more assumptions here, but the power, and some of you might be able to see what I'm getting at, is being able to increase the pool of assets almost immediately from just this 280,000. And if you add a $700,000 property, even with a loan, you've still now got almost $1 million worth of assets that's able to compound and grow just with the added expenses of a loan. But if we model that out over 10 years, even in a very simple case scenario, we're still looking at quite a sizable increase to the wealth creation over this time frame. And that's purely based on an opportunity that's only available within self-managed super funds because they have the unique ability to borrow money. There are some restrictions, which Andre will touch on a little bit more, but it's something that can only be done with this vehicle and obviously not traditional super. Of course, though, we do need to consider a few points before whether we want to look further at this option. The biggest red flag is anyone who's interested in talking about super because they want the money or somehow get access to the money now. If you ever see anything advertised online, which I have come across, if it's letting you know that you can somehow get access to your super now, it's almost definitely illegal, or actually it is 100% going to be illegal. And two, it's most likely a scam. So not only will you probably not get your money, but you may end up throwing away most of the savings you've built up. And a little quirk of super funds is that you actually get to choose the name and it can be almost anything you want. So some people get a bit caught up with this. And obviously it's a bit of a silly thing, but they like the idea of being able to come up and be a bit creative with the name. And these are actually real registered super funds that exist in the country today. Let's hope that the put everything on red super fund wasn't part of their investment strategy. The kids get nothing super fund might be a little bit more understandable. On a more serious note, there are some big reasons why we need to be careful, especially when you're including multiple members. So yes, there's cost to set up a super fund, but rarely is that going to be the biggest thing that you need to consider before you deciding to do this strategy. What's more important is, do you have the time to manage it properly, to keep all your records and look after the transactions and making sure you're basically following all the rules? Yes, you can get help from your accountants and advisors, but you are still ultimately responsible for the fund. And it is audited every year. So the threshold for doing your compliance for a super is much higher than with your personal tax. There are severe penalties for people who are running a super fund for making mistakes. There can be tens of thousands of dollars, including becoming banned. And the ATO doesn't care whether or not it was a mistake or intentional. The ATO is also quick to revoke your complying status these days if you get behind with your lodgements or make any mistakes with your fund. This can mean that you're not eligible to receive contributions. Your employer might not be able to make contributions to your account. You might not be able to make payments such as for your loan if you were to have a property. So there are lots of potential issues for getting behind with your administration of the fund. You also really need to think carefully about who you want to include in your fund. Because a lot of times a couple might be interested, but it can be siblings. In fact, there's not a lot of restrictions on who can be in the six members. There are some, but not a lot. However, you are all equally responsible for the fund. And if one person does something wrong, whether they take money out or invest in something they shouldn't, you can all be equally responsible for the consequences. You also, of course, do need to think about the future. So, divorce, separation, marriage, unexpected illness, and death can be a little bit complicated to manage and unwind with a self managed super fund. So, liquidity, some people get a bit remiss with their investment strategy. If you have a lot of things like gold or things that don't provide income, being able to afford to draw payments out to live on can be a problem. Poor performance can be an issue because sometimes managing investments isn't easy. And some owners of super funds tend to be a little bit narrow in their investment choice. They might like the idea of property, but not know much about other opportunities. And so they tend to stick to what they know. And if there's an issue with that market, like that particular shares or that property market, it can lead them to be underperforming what they might have had if they'd just gone with a traditional fund. I hope this gives you a bit of an insight in some of the things that we do need to consider, but also opens your eyes to some of the big opportunities that they provide in terms of investments and being able to use the very generous tax environment to make the most of your retirement savings with you in the driver's seat. Thank you.
All right. So let's talk about mortgage lending and self-managed super funds. For those of us who don't have enough balance to purchase investment property without a mortgage with your super balance. And so first things first, self-managed super fund lending is somewhat different to regular lending we might have all come across. SMSF itself is a separate entity. So whatever you have in your personal names does not impact borrowing capacity in self-managed super fund and vice versa. So if your broker or your bank has told you that your borrowing capacity is currently maxed out, it may not necessarily be the case, and you could potentially still borrow in the name of self-managed super fund. Other aspects of the servicing capacity calculations are pretty similar to regular lending. So we're using your superannuation contributions towards the servicing. Rental income will be shaded to 80% because banks like to be a little bit conservative. And again, with assessment rates, just like for regular mortgage, 2 to 3% will be added on top of the actual rate you're getting, just to make sure you can still service the mortgage in a case if rates go up. So in terms of client segmentation, we've got regular clients who are on wages. So your employer is paying your superannuation on top of your wage. You could potentially also be doing contributions voluntarily on top of it out of your wage that are tax deductible. So what we want to see is 6 months of service, or at least industry experience, in order to use those contributions. For those of us who are self-employed, banks want to see you paying yourself your superannuation, and banks want to see it on your tax returns. Ideally, you need to be paying it for 2 years. If you had only been paying yourself for 1 year, basically the lender will halve the superannuations that you have paid towards the servicing. Where it gets really interesting, instances when we only have one member to the self-managed super fund, it just really reduces the borrowing capacity. It's one thing to have husband and wife up to 6 because we've got 6 contributions going in. When it's only one member of the SMSF, borrowing capacity is significantly reduced, which makes it really difficult to borrow in the name of self-managed super fund. In that particular instance, we do have options of reviewing your financial position outside of SMSF to understand whether there is any room for any potential contributions. Again, bankers assess it very conservatively. As I mentioned, 80% of the rental income and assessment rate is higher than the actual rate. So that shortfall in servicing that we may have with the lender may not necessarily be the actual shortfall you will have with your self-managed super fund cash flow, but we do need to show information and any proposed super contribution that you could do. So in terms of deposits, if you are purchasing a regular residential property, you can go with as little as 10% deposit. You will have to pay lender's mortgage insurance and you won't get the best rate. Current rate is around 7.74 variable. If you do have 20% deposit sufficient in your super, this is when you avoid the lender's mortgage insurance and get more competitive rates. With 30%, it gets even better. If you are looking at commercial real estate, we do require a minimum of 20% deposit. There will be higher interest rate. So we've got Mr. and Mrs. Smith. This is a case study. They decided to open their own self-managed super fund. Anna works for state government on 130K gross annual income. She had around 170,000 super because she's been doing her additional contributions. And Peter is a tradie, self-employed, also been doing contributions towards his super and has around 90,000 in his super. Anna and Peter decided to open SMSF, and they combined have $260,000 in their superannuation. You can see the funding sheet up the top, basically outlining purchase price of the property they decided to buy of 650, associated purchase costs, stamp duty, and stuff. With their deposit of 250, as they decided to need 10K in their SMSF, they required a lending of 430,000. What they need security rate of 6.99%. Their repayments are around 650 per week. They purchased a townhouse here in Rapina, and that's currently being rented out for 680 per week, which means the tenants are covering the mortgage. The clients themselves don't need to pay for the corporate council rates, insurance, and stuff out of their super. So this is a real case study of real clients that I had worked with. All right. And this is all from me. We will be going over to Justin.
Thanks, Andre. Hey, everybody. My name's Justin. I'm the director of F5 Accountants. We're a small accounting firm that work with family groups and small businesses. Yeah, my part of the presentation will just give the general overview as to what a self-managed super fund is and just cover the areas that we haven't just spoken about just then. When it comes to a super fund, there's three main components. There's the trust deed, the members, and the trustees. So the trust deed, this is essentially the legal document that governs the rules and regulations of the self-managed super fund. It's typically 60 to 70 pages long, has to be drafted by a legal professional, and it's a legally binding document when all the trustees have signed. The next two key areas are the members and the trustees. A member is basically the person that has the benefit of the super fund. That's the whole reason the super fund exists, is for the benefit of the members. And the trustees are who's in control of the super fund. And as Paul touched on before, you can have between 1 to 6 members in a super fund. And then basically we've got two different options there in terms of who's going to be the trustee. You yourself as the member, you can be an individual trustee. So it'd be myself there as a member. If I had a super fund, I'd be Justin Fay as the individual trustee of the fund. So simple, but it can get a little bit complicated as I'll get to in a minute. So the other option there is having what's called a corporate trustee, which is where we've set up a company that its sole purpose of existence is to be the trustee for your super fund. And that's all it does. It just exists to basically control the super fund. In terms of all your bank statements, share documents, title deeds, it would say the company name as trustee for the super fund. If we have a bunch of members in a fund and we were all individual trustees, you can see this can sort to be a bit of a compliance nightmare. If we've got 4 people, it has to have all their names listed down on all the deeds, very long documentation, and it can be a bit of a nightmare if individual members want to leave. So if we had a son or something in a super fund and they wanted to remove their balance from the super fund, they'd have to basically roll over. We'd have to change all the titles and all the deeds. It can be a bit of a nightmare from that perspective. So that's one of the main benefits there of having a corporate trustee in place. One of the other main points to consider as well is if you were looking at property, the majority of lenders that you look at that provide loans for properties actually require a corporate trustee to be the trustee of the super fund. So in terms of setting up the super fund, basically once we've worked out who's going to be the trustee, the next step is we get the trust deed set up. If we did need that corporate trustee, like we just mentioned, we would then register that fund with ASIC to get the Australian company number. With the corporate trust deed, all the members basically need to become directors of that company. So we'll need to get director ID numbers for all the directors and the members. And then we need to get an ABN and TFN for the super fund. We then also need to get a dedicated self-managed super fund bank account all set up, which will then enable for all the contributions and rollovers. So what we do, we get that trust deed set up for you. We work out who's going to be in what position. We get everything registered with ASIC, get your ABN and TFN, and then all you need to do is get that director ID with the ATO, which we give you a step-by-step how to do that. And you go to the bank and ask for it to set up a self-managed super fund bank account with all the documents we give you. The next steps from there is we help you get what's called an ESA, electronic services address, which is basically the clearinghouse that the ATO needs as part of having a super fund, which also enables for those rollovers. So it's all just part of that setup process that we do. So just in terms of if you were looking at getting a loan to buy a property, we actually need to set up a separate trust called a bear trust. And it's a legal requirement. The reason for this is if anything was to happen with your loan, like you were to default on your loan, the lender can only go after the property. It keeps your main funds over here in the super fund separate, and then you've got the bear trust over here. So it's a legal requirement that if you wanted to get a loan for a property, we have to set up a bear trust with its own corporate trustee entity. But at the end of the day, they mandate that as a requirement to give you that protection in case anything was to happen to the property or to your loan. Your assets over here are protected. And then once the loan's repaid, the property is then transferred back to the self-managed super fund, and the bear trust is closed and there's no tax consequences. It's as if the bear trust never existed. What's the sort of ongoing costs and compliance, or how's it all sort of work? Yep, as Paul touched on before, we need to do an annual tax return and prepare financial statements every year. We also need to get an independent auditor to audit the fund. And then if we have property, we need to get periodic valuations done on the property, typically every 3 years, but things changing quite materially, we have to get it every year. So property market being what it is, sometimes it might be every year as it's been at the moment. Yep. So what are the sort of costs that are involved? Generic example where we've got a husband-wife situation and they want to get a property. It's just under $5,000 typically to get a self-managed super fund all set up. And then your ongoing accounting and audit needs are about $2,000 a year. So as a frame of reference, that's the sort of pricing you'd be looking at to set up and then for your ongoing compliance needs.
I know there was a lot of information, but at the end of the day, us as professional, we do everything. We just wanted to outline the process. Look forward to working with everyone, and thank you so much for your time.
Thanks, everyone.
Have a good night.
Bye, everyone.